Everyone, and welcome to this webinar. I'm glad we're all able to make it to today's session, and we hope this will be helpful to you. For those of you who do not know me, my name is David Gazai, and I am Orchestras Canada's Director of Member Services and Learning. Before we get started, I would like to take a few moments to mention that Orchestras Canada is a virtual organization. What that means is that we all work from where we live. For example, my office is located in Kingston, Ontario, on the traditional lands of the Anishinaabe, Haudenosaunee, and the Huron-Wendat, and I recognize the enduring presence of the First Peoples. I want everyone to know that today's session is being recorded and will be shared with the registrants soon. The session will be followed by a Q&A, so please put any questions you might have in the chat, and we'll make sure to address it in the later part of the webinar. Let's get to it. I'm happy to introduce Alicia McGuire, Senior Payroll Consultant at Young Associates. Alicia was kind enough to make time for today's session without much notice. So since new regulations have been put in place in the upcoming deadline of February 29th, which I'm sure everybody is very excited about, this means that this information will still be very important to you. So without further ado, I will pass the mic to Alicia.
Okay, now I get to share my screen, so just bear with me for 1 second. All right. Thank you, David. Thank you so much for everyone joining us today. I'm very much looking forward to presenting some payroll legislative updates for you all. I'm going to do my best to keep the information portion of the presentation to about 40 minutes to allow questions at the end. But feel free to put questions in the chat while I'm speaking to keep it fresh in your mind. And then we'll get back to them at the end. So let's jump in. As mentioned, my name is Alicia McGuire. I'm the Senior Payroll Consultant at Young Associates. I work with small business owners, charities, and nonprofits that handle their own payroll but need a little help here and there. In the interest of times, we are going to go through topics very quickly. I'm essentially taking a 4-hour National Payroll Institute seminars worth of information and whittling it down to 40 minutes for our presentation today. That being said, the slides will be made available, and if you have any questions we do not get to today, my information is in the slide deck, and you can reference it. And I do hope that I will get to work with some of you in the future. Finally, before I jump in, just a little disclaimer that while I do my best to make this information as up to date as possible, this presentation is for information purposes only and should not be considered legal advice in any way. If the government source contrasts with information I presented today, please make sure the government source prevails. I know that there's a lot of you attending today that don't so much have a passion for payroll, shall we say. I'm guessing most of you cringe at the thought of all things payroll. I'm hoping by the end of today, I can build your confidence just a little bit with your day-to-day encounters with payroll. So let's start with the basics. Year-end basics, year-end basics are the foundation for T4 processing. Every year, even if you only have a payroll of 1, there are certain tasks that should be performed at the end of the year of each calendar year. The payroll reconciliation will give you the basis for feeling confident that your source deductions have been remitted throughout the year are correct, and if any additional remittances are required. Balancing by the boxes on the T4 often what I recommend. This means confirming benefit premiums that are taxable are reconciled to statements and included in box 14 and 40 on your T4 statements. It should also, you should also be confirming CPP and EI deductions have been taken correctly throughout the year. Keeping in mind that those that start or end employment through the year are under 18 or over 70 in a calendar year, or will have or have small earnings for 1 or more pay period, will have a partial CPP exemption, or earnings that need to be removed from the CPP calculation in order to confirm the deducted amounts are correct. A change has been made in regards to electronic filing of slips on January 1st, 2024, and T-slips being filed must be filed in an electronic format such as an XML file or web forms, if you are filing greater than 5 slips. This is down from the previous 50 slip limit. Lastly, please confirm your payroll processing schedule for 2024 to confirm if there are any payroll dates or processing dates that need to be altered because of bank closures, or if you are in a 27 or 53 pay period year for those that pay biweekly or weekly. If you pay semi-monthly, you still want to confirm if any stat holidays alter your pay schedule. Another year-end best practice is to confirm if employees have changes in circumstances that require a new TD1 form to be completed. If all staff take basic exemptions, then new slips are not necessary. But if anyone takes additional exemption, or especially if they're having no tax deducted because their earnings were or are below the threshold, it's best to do due diligence and remind employees to complete new TD1s if their situation has changed. Keep proof of this exchange to avoid any failure to withhold penalty from the CRA if that were ever to become an issue. Please remember, unless you actually are a tax expert, you never want to be giving tax advice, which includes non-advising someone on the boxes to complete on their TD1 form. I have included a link here to the 2024 TD1 forms for anybody that needs to distribute a copy or would like to share the link with their employees. So the first legislative update I want to jump into is the 2024 CBP enhancement. While this isn't entirely new for 2024, there are big changes to CBP enhancement for 2024. As you're probably aware, CBP has been increasing since 2019 from 5.1% to the current 5.95%. While this rate remains unchanged for 2024, there is a new contribution, CPP2, that will be required for employees who earn greater than $68,500 in a calendar year. Before 2024, an employee who reached the yearly maximum pensionable earning contribution stopped contributing to CPP until the first pay of the following year. With the introduction of CPP2, there's an additional contribution for anyone that meets the YMPE. The CPP2 should be withheld at a rate of 4% for each of the employee and the employer for a total remittance of 8%. This will be calculated on earnings between the yearly maximal pensionable earnings and the yearly additional maximum pensionable earnings of $73,200. You will not add the 4% to the 5.95% rate. You will simply use 4% rate only. This amount must be tracked separately, as it will be reported separately on the T4. As stated, the YMPE for 2024 is $68,500 and the YAMPE is $73,200. All of this means that if you have employees that earn more than $68,500 in 2024, their CPP contributions for the employee and the employer will be up to $188 per employee greater than they were in 2023. I have included QPP in this slide deck as well. I know we don't have any Quebec participants, but I wasn't sure if we had anybody that had Quebec employees remotely. And if you do, they're essentially the exact same calculation, just at a different rate. I do also have scenarios in this slide deck that in interest of time, I'm not going to go through, but it does outline scenario 1 where an employee makes less than the YMPE, which essentially means that you're doing nothing. It's going to be the same as 2023. Those that make between YMPE and YAMPE, and that calculation as well. And then those that make more than $73,200 per year with that calculation. So please feel free to review those scenarios if you want to know what the calculations are for those different situations. So the second biggest change, which is in effect for 2023, is the 2023 tax year, is the new requirement for the Dental Care Measures Act reporting requirement on the T4. All employers are required in 2023 on the 2023 T4s to report if an employee has access, keyword being access, to a dental plan of any kind or dental coverage of any kind. This reporting is mandatory, and all employees must have a T4 even if they do not have earnings for 2023. This box reports for a single date. It will only be reported for an employee that had access or not to a dental care plan on that singular date. The date for which the box should be completed is December 31st, 2023. This is a snapshot in time. It does not matter if they have eligibility before or after. The only day that matters is December 31st, 2023. So there are 5 options for completing box 45 on the T4 or box 015 on the T4A. The first is code 1, not eligible or no coverage, or coverage for dental services of any kind. This will often apply to terminated employees, even if you do have a dental care plan. Or if your company does not, or your organization does not provide dental care plan or health service spending account or anything like that that covers dental procedures or cleanings, then you would be code 1. Also, if your employee is not eligible because of like hours worked or something like that, or if they're going to become eligible on a future date, it doesn't matter. They're still code 1. Code 2 is if you only cover payees. So they don't have the option of putting spouses or dependent children on. It's just the payees, but they do have coverage for the employee. Code 3 is going to be the most commonly used one, where your plan does allow for payees, spouse, and dependent children to be covered. Doesn't matter who pays the premiums. If the employee pays premiums for their spouse or their children, or even themselves, they still have access to a dental care plan that provides for payees, spouse, and dependent children. It also doesn't matter if they actually opt into that service or not, or whether they even have dependent children or spouses or not. If they're single, it is still code 3 if they have access to a plan that allows payees, spouse, and dependent children. Code 4 is for those plans that only cover payees and their spouses, and code 5 would be for any plan that only covers payees and their dependent children and not spouses. Less common, but there are plans out there that do only cover those 2 categories. If an employee is terminated or not eligible to participate in the company dental plan on December 31st, 2023, then they are code 1, regardless of if they will be eligible on a future date or were eligible at a prior moment when they were an active employee. If benefits are available to retirees of an organization, then it should be reported on a T4A in box 015, not on a T4. This probably isn't applicable to any of your organizations, but if a dental plan is provided by a union, then the company would report code 1, and the union would have a separate T4 that reports the access for their union members. So I hope everyone's feeling good about CPP Enhancement and Dental Care Measures Act, because the next section is going to be something I've already mentioned, which is about the electronic filing changes, decreasing from 50 to 5 slips, but also effective January 1st for any individual that has a MyCRA account. The information delivery method will be defaulted to electronic delivery. This has already come into effect for my business account users effective June 22nd, 2023. This means that businesses and individuals will receive correspondence from the CRA in their My Business or MyCRA account rather than in a paper copy. Note that this also applies for notice of assessments, just as a fun fact, or for your personal information, or if any employee does question where this information can be found. Also this year, T4As and T5s could be sent out in an electronic portal without the direct consent of recipients. This has been in the works for a while, but the bill has now received royal assent, so it is now applicable to the 2023 tax year, and any slips that are dated 2021 or later. There still is the same requirement that you provide a paper copy if requested, and you must have a reasonable expectation that the recipient can print a copy of the slip, but otherwise you do not need to have direct consent. The other point of note is if somebody is on extended leave and is receiving a T4A, they should be sent a paper copy rather than an electronic one. Moving along, there was also a major change in 2024 to province of employment rules. There is a lot of information in the next few slides, most of which comes directly from the CRA resources. But essentially what it comes down to is that there's a new CRA administrative policy that can be optionally used to determine province of employment for source deduction purposes for those employees that are contracted full-time remote employees. A point of importance here is this only applies to income tax, CPP, QPP, QPIP, and EI withholdings. It does not change the requirement to consult the province of residence for benefits coverage, workers' compensation, and employment standards. The new policy allows employees to be reasonably considered attached to an establishment of the employer. This means that if you have a fully remote employee that was considered an Ontario employee, for example, because their payroll was being processed in Ontario, but the employee has an establishment in the same province that the remote employee resides, they can now be reasonably attached to that employment location. So say you have an Alberta employee and you have an Alberta office, but your payroll was processed out of Ontario, they now can be reasonably attached to Alberta and now be paid. Their source deductions can be taken as an Alberta employee. This does not mean you can use this policy to avoid source deductions, and employees' home offices are still not considered a place of employment for establishing the province of employment. What it does mean is that they now have an option for remote employees who are located in a place that's completely different from where your payroll is processed to have a different option for determining the province of employment, more closely related to their province of residence. Lastly, if an employee can be tied to more than one establishment, then the employer must determine which establishment the employee most closely attaches to. So it is under the employer's discretion rather than the employee's. The remainder of these slides, I'm not going to talk to too much, but it basically goes through the primary and secondary indicators for determining whether an employee can be reasonably attached to an establishment. If this is something that applies to you, it's worth reading through this information. And there's also an example that I've included in the slide deck. So the last general topic for today is taxable benefits. I could speak for days, weeks, years about various taxable benefits that any organization could encounter, but I'm going to keep this brief in the interest of time. That being said, if you do have questions that can be answered today, I'm happy to do so. I'm also happy to direct you to Young Associates Payroll Services, where we are happy to provide payroll consultations, including taxable benefits, vacation policies, or anything else you feel you need clarity on. Please feel free to visit our website or email me directly if you would like to learn more. There were several changes to taxable benefits in the 2022-2023 years. Gifts and awards, cell phones, loyalty and points programs, parking, social events, all had changes in these tax years. There aren't so many for 2024, but they were big changes for 22-23 that I still find people are not aware of. The big change for gifts and awards and long service awards was the addition of the administrative policy that allows gift cards to be considered non-cash and therefore eligible to be considered in the $500 non-exempt gift and award or long service award threshold. It was originally not applicable to long service awards, but as of 2023, it can now be applied to long service awards as well. A gift or award is considered non-taxable If it is a small item of trivial value, like a coffee mug or coffee or tea, a t-shirt, a plaque, a trophy, something along that line, or the value of the gift is $500 or less. This includes taxes, by the way, so that everybody knows we all have to pay taxes in Canada. So any amount over this value does become a taxable benefit. In order for the gift or reward to be non-taxable, it has to be a gift for a special occasion or an award in recognition of an employee's overall contribution to the workplace. It cannot be provided for a reward for job performance. If you are giving a reward for job performance, that is a taxable benefit. That is income to the employee. Long service awards have their own $500 limit. You cannot include gifts and awards in the $500 limit if the gift and award is provided to a non-arm's length employee, so a family member or a child, a spouse. It can't be provided by a manufacturer or other pay to your employees. It can't be part of a prize draw. It can't be part of a loyalty program. It has its own rules. And it can't be part of a social event or hospitality function because, again, it has its own rules. So in order for a gift card to be considered non-cash and therefore eligible to be considered as part of a gift or award, long service award, or social hospitality event, the gift card has to follow all of the following things. It has to come with money already on it for purchase of goods or services to a single retailer or group of retailer identified on the card. Be careful that it is a retailer and not a distributor. For example, Amazon gift cards are not allowed to be considered non-cash because CRA considers Amazon to be a distributor, not a retailer. The terms and the conditions of the gift card must be clearly stated that the gift card cannot be converted into cash, which most of them do anyway, and a log must be kept, including the name of the employee, the date the gift card was provided, the reason for providing the gift card, the type of gift card, the amount of the gift card, and the name of the retailer or retailers in order for you to consider the gift card non-cash. As I said, long service awards have their own $500 value. They are considered non-taxable if it is a non-cash gift or award. It is in recognition of 5 or more years of service with the employer. It has been at least 5 years since the last long service award. The fair market value of the award is $500 or less, again, including taxes. And in 2023, the CRA did add that gift cards can be considered non-cash and can be applied to long service awards. The unused portion of a $500 long service award limit cannot be applied to non-cash gifts and awards. There's never a case where you can add on the extra money if you don't use the full amount for the long service award. Well, a lot of things can fall into non-cash. Beware of near cash items that cannot be included in the $500 non-taxable limit and should always be considered a employment income and reported on the T4. Near cash items include something that's easily converted to cash, like bonds, securities, precious metals, jewels. I don't know who's giving out precious metals or jewels, but I want to work for them. A gift card that does not meet all the conditions of the card to be considered. So, example again, Amazon gift cards are always considered taxable. And then a prepaid card from a financial institution or a payment card network, such as MasterCard or Visa, cannot be considered a non-cash gift card. And then digital currency, such as cryptocurrency, is always income and always it needs to be reported in box 14 and 40 on T4. Non-cash gifts and awards that are taxable. So if you go over the limit or there's some other reason why a non-cash item needs to be taxable, it is also pensionable but not insurable for EI. So you don't take EI deductions on that, but cash taxable benefits are pensionable and insurable. The next change to taxable benefits in 2022 was social and hospitality events. CRA defines a social event as a providing a free party or other event, such as holiday party, seasonal function, company picnic, or other social gathering, whereas the hospitality function is a meal or other hospitality service in a work-related function that is not a social event. This includes team building lunches or motivational planning, education, and networking sessions. Under the CRA administrative policy, if you provide a free party or social event in person, it is non-taxable. If it is available to all employees, the cost is $150 or less, including taxes per person. Persons do include spouses or common law partners when you're calculating that $150 per person. Auxiliary costs such as transportation, home, taxi fares, and overnight accommodations do not need to be included in that 150 or less limit. And if you provide gift cards to employees attending virtually, then it must meet the conditions of the gift cards. The event and is also, it needs to be within the maximum annual limit of social events, which is a total of 6 employer paid combined in-person or virtual social events per calendar year. If the total cost of the event, not including auxiliary cost, is more than the limit per person, more than $150 per person, then the full amount becomes taxable, including the auxiliary costs and including any spouse or common law partner in attendance, becomes a taxable benefit to the employee. So you then need to include not only the $150 limit, it does not get to be removed from the taxable benefit. That the same thing goes for virtual events. They are considered non-taxable if the virtual event includes a meal, beverage, or delivery service and is less than $50, including taxes per employee, or if it also includes entertainment, then the total cost needs to be $100 or less per employee. Again, if you provide gift cards for the meal, beverage, or delivery service, the card must be considered, it must follow the gift card considerations. And if you reimburse expenses or provide accountable advances, then the employee must send receipts for those reimbursements. And again, the event must be within the maximum limit, which is 6 employer paid in-person or virtual social events. Again, if the cost is more than the limit per person, the full amount is taxable. You cannot reduce it by $50 or $100. And it would be reported in box 14 and 40 on the T4. There was also a change in 2023 to the administrative policy on loans. This was a super welcome change for us payroll providers because there was taxable consideration for payroll mistakes. They were considered loans. So now if the loan meets certain requirements, we're no longer needing to make the interest expense taxable. So the considerations are that the total amount of the loan or loans, you can have several loans in this, is less than $10,000 per calendar year. The term of the loan is 60 days or less, and the loan is not received because of shareholdings. If the full principal is not repaid in 60 days, the interest benefit is taxable. If the interest benefit is taxable, it gets reported in box 14 and code 36 on the T4. If any part of the loan is reimbursed or forgiven, then it goes into box 14 and 40. On the T4A, a loan benefit goes into code 117. I've included a slide here on mileage. The prescribed rate for reimbursing mileage has changed in 2024. The rates are provided here depending on the situation the employee is in. Just to keep in mind with mileage that if you reimburse higher or lower than the CRA prescribed rate, the whole amount becomes taxable to the employee. So it's important that every year you are keeping up with, if you do reimburse for mileage, you are keeping up with the prescribed rates from the CRA, because it does. If you use the prescribed rate from the prior year, it's probably going to be taxable to the employee because it's going to be lower than the current prescribed rate. Well, I don't want to take up too much time. I do have some slides that are provincial changes specific to the different provinces. I'm not going to go through them in details, but the highlights are basically there's some pay transparency changes in BC and Ontario. There's some new health tax brackets in Manitoba. There's some new tax brackets in Manitoba. They've changed the amounts for their tax brackets. Newfoundland and Labrador have a new amount for their payroll tax. It's gone from a $1.3 million exemption to a $2 million exemption. Nova Scotia has had a change that allows unpaid days for loss of pregnancy, which I find very interesting. And they now disallow requirements for sick notes by employers. So employers are no longer allowed to ask for sick notes unless under certain circumstances. This was actually implemented in recognition of the strain that the requirement for notes puts on the healthcare system. So I think we're going to start to see that come into effect for a lot of provinces. So I'm on the lookout for that one. Ontario had a similar rule, but I think that they wiped that out after COVID. But I could see that coming back in. PEI had some workers' compensation changes on how they deal with the maximum annual earnings. EHT in Ontario stayed the same at 1 million. For those employers that qualify, if you don't qualify for exemption, there are different rates if you're under that $1 million. But I figured most of you probably qualify for the exemption. It's usually just like people that are tied to government often. If you do need to know those rates, they are in the resources. And finally, Quebec has harmonized its province of employment rules. So there's no longer a requirement to declare training activities other than on the RL1 summary. The harmonization of province of employment was a big deal in Quebec because now they have the same rule as everybody else, which is great because I hated that they always had a different rule for everything. So you can reasonably attach someone to a Quebec employer, even if they don't, if the payroll isn't processed in Quebec, which is great for Quebec residents that work for non-Quebec employers or remote employers. Lastly, I have a slide of the current minimum wage for every jurisdiction. I've also included possible upcoming changes for anybody in these provinces, or if you're a federally regulated employer that follows the CLC, there's changes that are coming in 2024. So this concludes the information portion of the presentation. Before I jump into questions, I just want to say thank you so much for putting up with me today and listening to the abundance of information. I hope that you all have a takeaway from today to help you feel more comfortable with tax slip filings. And if you haven't done so already, or if you have in your 2024 processing of payroll, I really appreciate everyone's willingness to come and learn and gain a little more confidence in the world of payroll. Again, with the time remaining, I am happy to answer some questions, and I will leave the resources up on the screen for now, unless David, you want to put up the other screen. Will we answer some questions?
That sounds perfect. Thank you so much, Alicia. That was super interesting. A lot of changes, and it's interesting to see the difference between all the provinces and how Quebec seems to align somehow. It's always great to see. I mean, it makes things easier on your end, I'm assuming.
Oh, definitely. It also makes it easier on the employers because having to know different rules for Quebec if you have an establishment there, or if you don't have an establishment there but you have remote workers there, always became such a challenge. So it is nice to see them aligning for sure.
Yeah. All right, first question just came in. Do we have, oh, you can see them probably too, right?
I cannot. No, I have
Okay,
to. I
that's
have to
okay.
stop presenting in order to see them. So
That's fine. I will be the verbalizer of the typed answers. Question. So, do we have to put the dental codes in the 2023 T4?
yes, yes, it is mandatory for 2023 when you are issuing T4s. It is only mandatory on T4As if you're issuing for pension income or sub-annuities. So it's not like if you're doing T4As for fees for service, you don't have to put it on the T4A. It's not mandatory for the T4A, but it is mandatory for the T4 for all employees. And again, regardless of whether they actually had employment income. So if you have an employee that's on leave that had no income, parental leave, for example, they still need to have a T4 with that box 45 completed.
Right. So I'm gonna say right now, we have either two scenarios that people are frantically typing their questions as we speak, or your presentation was so thorough that they don't have any more questions. So one of the two, and or a mix of
I'll
both.
take it. I'll take it. Yeah. Or it was so confusing that no, I'm just kidding. I hope it wasn't that one. I know I actually did a CPP exclusive, like it was just CPP enhancement. I thought, oh, there'd be so many questions. There was no questions. Everyone was like, oh, I'm cool now. I'm like, oh, that's great. I'm
I
glad
get
I
it. I
could,
understand now.
yeah, I'm glad I could explain it in a way that makes sense to people. Because I know when I first heard it, I was like, they're doing what now?
All right, I guess we'll give it a little bit more time if people have any more questions.
Give it a few
Yeah.
more minutes. I mean, it doesn't have to be related to this. If you have a payroll question outside of legislative updates, I'm happy to answer that as well.
Yes, the slides and recording will be available.
Yes. Yeah.
Which will make it a lot easier to go back to a specific spot or to find the right slide and the actual statistics or
Yes, and I did
number.
include information that I didn't speak to
Yeah.
for that purpose, so that everybody has the information regardless of whether I actually presented the information or not. I will say the resources also have additional information, additional links to some government sources and things like that that are super helpful.
Right, perfect. Yeah, this is great. Another question that just came in, how often should people check for changes in payroll requirements? Annually, semi-annually, or ...
So I used to say annually. I would say now you want to be checking at least monthly. The CRA seems to like to throw random things out there and they don't tell anybody. They just release it. Or that's what it's been feeling like over the last couple of years. So I usually say it's nice to just have a quick read, or subscribe to some sort of social media or something like that in the payroll field or the HR field that kind of give updates, but definitely once a year, kind of this time of year prior to filing T4s, prior to kind of finishing your year-end process, just checking in to see what's changed in the year prior is a good point. Especially because I know a lot of you guys are running multiple things, you wear multiple hats. At least once a year would be kind of the minimum.
The part this, I guess it's just on a personal note, but I thought was interesting is the whole mileage amount. How if you get paid more for mileage, then it becomes taxable, but even taxable even if you get paid less.
Yeah, yeah. I've never understood that one. I remember learning that in my first year, like 15 years ago, and them saying that and I go, how does that make sense? I think that the reasoning behind that policy was they want you to make sure you're using their prescribed rate. So, and they want you to be updating that. So
Yeah.
they want to make sure that you are using the prescribed rate. Therefore, if it's lower than the prescribed rate because you're using last year's, it's a taxable benefit.
Fair
And
enough.
usually what happens is the employer gets dinged for that one because they didn't even realize. It usually doesn't fall on the employee. It usually falls on the employer because they don't do it. Yeah.
Fair enough. Another question that came in, Will most payroll systems automatically take CPP2 off, or is that something we have to calculate manually?
Most payroll systems have a mechanism for the CPP2. I can't speak to how well they will do it. I don't necessarily advise against checking yourself, but definitely you're going to want to check yourself at year end. So if you do have employees that are going to either be between those two amounts or over the 73,200, I do recommend just knowing or being aware that it should happen so that you can be vigilant to whether or not your payroll software is calculating it properly. And something I didn't mention, and I'm sorry about that, is that in addition to the 1% tax, the 1% tax, the word I'm looking for, I apologize, tax deductible amount for CPP, the 4% is actually fully tax deductible. So people will see less tax on the periods or periods in which they have CPP2 deducted. That's kind of a nice bonus to the, I mean, they're also going to get additional CPP when they retire, which is also a nice bonus for people. So
Definitely, yeah.
I see the philosophy behind the CPP enhancement. It's just going to hurt in the moment.
Right.
Yes. Yeah.
And Catherine just put in the chat that there's a handy what's new section on the CRA website, and
Yep.
she posted the link there. So definitely something to bookmark and to give it a read the first Monday of every month while having coffee in the morning, or
Sounds like that's a great tip, Catherine. Thank you.
make it a tradition. All right. Well, it looks like that's it. So
Great.
I guess it was very thorough.
That's what I like to hear. And of course, you can always reach out to me if you know, because I know what happens to me. You'll end a webinar or you'll end a phone call with someone, and it's like, oh, I have like 3 more questions that I totally forgot about at that moment. So do feel free to reach out to me if you do have questions that come up after the presentation. I'm happy to answer anything that comes up.
Right. Well, thank you so much for the offer, Alicia. This is great. Thank you again for the presentation. Thank you for those who attended. As I said earlier, this session was recorded, so we will be sharing with you the recording and the slides to you and anybody else who registered for this session. We'll do that in the coming week. So keep an eye out in your emails and it will be there. Other than that, if there's no more question, then thanks again for coming and have a great rest of your day.
Thank you.
And reach out to Alicia.